you're seeing a situation where if you did hold gold, if gold was 5 to 10% of your portfolio, it did exactly what it needs to do. It preserved capital in times when anything that has to do with growth did not, or did not do it very well. So it is doing exactly what it needs to do.
Welcome to the My Future Business Show, where we get you in front of your best audience and keep you there. Not only are we interviewing the biggest names in business to help you become even more successful, we're inviting you to book your spot on the show to help you grow your business. So at the end of the call, make sure you fill in the interview application form at myfuturebusiness.com/interviews. Welcome back to the My Future Business Show. It's Rick Nuske here. I hope you're doing really well. Thank you very much for joining us. Now, if you've been supporting the show for any length of time, thank you very much for that support. And I know there's been a lot of new people joining us on the show, and I've been receiving their feedback, so welcome. If this is your first time, you are definitely in for a treat, because today I have the pleasure of welcoming back a gentleman who often speaks with me about markets and what's happening globally. And with that, it's Mr. Lior Gantz. Welcome back to the show, Lior.
Thanks for having me back.
Absolutely. Now, as you and I were talking about just briefly prior to the call, there are definitely new people listening into the show. So I think we better go over some basics just so they get a bit of a feel for who you are. But I'll start off by saying that you're from the Wealth Research Group. We're going to be getting your perspective of current global events, including the impact of the war in Europe, the impact of inflation, a possible recession, and to consider if we're heading for a market meltdown, and what all of this might mean for investors in the short, medium, and long term. Now, before we do any of that, Lior, just for context, where are you calling in from today?
Tel Aviv.
Tel Aviv, right. Now, tell me about Tel Aviv. What do you like about the place? Have you lived there forever? Tell us a little bit about it.
Actually, I've not lived here forever. I've lived here for since the virus became a pandemic.
Yep.
So before that, like 2 years between early 2018 and early 2020.
Mm-hmm.
Myself, my wife, and then our 1.5-year-old daughter at the time. Now she's 6.
Yep.
We basically traveled while we were doing our business for 2 years. And then if you remember Kobe Bryant dying, that was late January 2020.
Certainly do.
That was like the end of our 2-year journey, and then we were like figuring out, do we want to do another year or what do we want to do?
Mm-hmm.
And then everything changed. So we came right back here.
Yep.
I've never lived in Tel Aviv. I've lived in the metropolitan, but not inside of the real hub.
Yep.
So we took an apartment in a high-rise, and we're literally finishing our 2.5-year lease.
Yes.
And moving 6 stories up in this high-rise because we just had twin boys.
Oh, wow. Congratulations.
5 months ago.
Oh, wow. A very busy man at the moment.
Yeah, I don't know. My wife went to a yoga retreat like 14 months ago. So
yeah.
all the numbers make sense.
I love it. Now, I think that's probably a good segue to talk a little bit about the pandemic. You've touched on it, and it's part of the reason you were moving around. But I wonder, from a wealth research group perspective, what's your take on the pandemic? What's happened in the markets as a result directly of the pandemic, and have there been any upsides?
So when I really think about it, and think about what the pandemic did, it was a big enough event.
Yep.
And a lengthy enough event with a significant amount of people and institutions and entities and countries involved, that it changed the way that we operate. We, meaning individuals, some less, some more, businesses, municipalities, governments, and then the international community. So everything has changed. And as you know, when I was in the IDF, they used to tell us that when you navigate with the compass, if you miss by 1 degree and you walk that degree for 20 kilometers, you're going to be somewhere else. So I think that's what happened. Everyone made there's little incremental changes, and we're in a new world basically. And in this new world, you have issues with balances between supply and demand because usually it's easy to foresee changes, or easier to foresee changes for businesses, for governments, etc., because they do so many surveys, and they know their customer base and they know the citizens, etc.
Yep.
But when you shuffle everything around so quickly, you get unexpected things, or what we call in finance and economics, unintended consequences. So I think that's what we're facing right now. We're facing huge unintended consequences. Some more predictable, like some you could say, man, you could have seen that coming.
Yep.
And some less. Some think that governments do this on purpose. Some do not. Like, people have all sorts of ideas as to whether or not this is like a deliberate crash or like a reset. That idea has been floating around for decades, that governments are trying to crash the world's economy in order to create a new, better world, or a new, not better world. So anyways, what we're seeing from this pandemic, I think, in the biggest level, as I think we're seeing changes. Let me number a couple of them so that we can learn a little bit more about what world we're getting into. One, and this is one of the biggest, I think the biggest change, I think we hit peak globalization.
Right.
That's the number one overarching theme that I think everyone should think about, because it's a theme that I think will last for 2, 3, 4 decades.
Wow.
Yeah.
It's a long time. That's a lifetime.
Yeah. Deglobalization and globalization cycles are usually half a century long.
Yep.
Globalization, while it has its victims, it normally coincides with lengthy peace periods, lots of wealth creation, and poverty eradication, because the arbitrages are diminished. In other words, if there's a cheap labor country, it all of a sudden rises because capital flows there, human ideas. Okay. And clearest example being China with this one. And deglobalization periods coincide with nationalism, with extreme nationalism, with wars, and with closed borders. And the last cycle was 1910 till 1950. So if we look at 1910 until 1950, you have the formation of central banks, World War One, the Great Depression, World War Two, 2 nuclear bombs.
Yes.
In real life.
In the mix.
So, yeah. So I think people should understand that we're going into a period where normally bad things happen, and you're already seeing the starting gun with war in Europe, supply chain issues around the globe, inflation, higher interest rates, perhaps a recession in some developed countries. That's number one. I think that's something we should all consider. Because it's been strawberries for a very long time now. In Israel, we say it's been strawberries, like it's been good.
Yeah.
And another kind of analogy is this idea of a soft landing or hard landing. But no matter how you look at it, this plane is landing, so the vacation is over. So another way to think about it. Secondly, so deglobalization, that's big. Like you should study this for a very long time, read books about it, understand this is going to be something that impacts you no matter where you are. Secondly, I think what we're facing is a population shortage in the working class demographics, so the 25 to 65 years old. Basically, the last wave of globalization relied upon 500 million rice farmers urbanizing in Asia. And that's over. In 2010, the urbanization period in China was finished. And that's why you see in America right now 11 million job openings and 6 million applicants. which means that even if the 6 million applicants are suitable and skilled in the jobs that the 11 million openings require,
Mm-hmm.
which is obviously never the case, you still have a 5 million worker shortage in the
Deficit.
United States. Yeah.
Wow, scary.
Um, and that's not just in the U.S. It's going to
So
be in
everywhere.
a lot of other places. Yes, because of fertility rates and the way that the developed economies have children later on and less children and less children. Europe is one clear example of this. So, and obviously China now is a good
Mm-hmm.
example. Okay, so we're seeing worker shortage. This is going to be something that will need to be handled by robotics and automation and technology and AI, etc. But that it's something that's not going away today or tomorrow or this is something that's going to last a
It's a
decade or
headwind.
more.
Yep.
Yeah, it's a challenge.
Yep.
And third, and this is a big one, central banks and government stimulus has become unpopular because for 13 years, zero interest rates and stimulus have sparked a lot of growth companies, VC fortunes,
Mm-hmm.
etc.
Yep.
But now, in the eyes of the public, it is the stimulus and the stimulus checks and the unprecedented bailouts from central banks that have caused the inflation we're seeing right now in the world. So it's not popular anymore politically or monetarily to pump out cheap credit in order to stimulate the economy.
Yep.
That's a big change. So a third big change.
Yep.
And I think the fourth uh, major thing that we're seeing right now is the difference between pricing in the stock market and pricing in real estate markets. You're seeing the stock market is a much more um, it's because it's so easy to sell and buy stocks.
Mm-hmm.
People sell them and buy them without regards to the fundamentals. Whereas real estate, it's not,
Not that
it's not
easy.
something that you get up in the morning and just say, you know what,
Gonna
if the
flip it.
market open, I'm gonna, yeah.
Yep.
And so you're seeing real estate moving way slower
Mm-hmm.
in terms of pricing
Yep.
than than stocks, and that's something I think people should consider because it's going to make. I think it's making real estate a far better preserver of wealth for shorter periods. I think people are going to continue to treat their real estate as something that they never want to sell. When they buy, they're going to hold
Hold it.
for a very long time. Even if interest rates are going to go up and mortgage rates are going to go up, I don't think people are going to sell. People are, all around the globe, I'm hearing there's going to be the largest crash in history, all that kind of stuff. I don't believe so. And in fact, like if one could say that the opportunity is in the arbitrage between
The difference.
the pricing in real estate that stays very constant, very stable,
Mm-hmm.
and the discounts in stocks. If I was, to think about a strategy here, I would take a line of credit on my house, and I would partly use it to buy world-class companies that are now very attractive. For an example, okay, so that's another big thing that I think
Yeah.
people
Thank you
should
for sharing. Yep.
understand. But by the way, Rick, I put together sort of these very comprehensive reports that obviously include more charts and visuals because we can't get into it in like an
No,
interview.
not
I think,
visually at least.
yeah, definitely. So if people want to go and check out and download these reports, we put them together from proprietary research and stuff that costs us like thousands of dollars to access from the biggest consulting firms
Yep.
out there. If you want to go to wealthresearchgroup.com/pain, like PAIN,
Mm-hmm.
/rug, like rug pull, like a RUG, and
Mm-hmm.
/bear. I think those are three reports that people would definitely want to check out in terms of understanding where we are with the bear market, with the recession, and with the housing market.
Yes, absolutely. Thank you very much. I'll be making sure to put those links below this post, no matter where you're seeing the call. Thank you again. Now, I know that there's never a good time to being an investor, and I see that many people I hear say that if the US catches a cold, the rest of us catch it as well. And I see this ripple effect with inflation. Not a month ago, weeks ago, in fact, they had their first significant raise in inflation in rates, and all of a sudden, the rest of us see this effect where we're paying more for mortgages. Why is that? Why is it that we base everything seemingly around what happens in the US?
So, for one, the U.S. is the largest economy in the world, the most complex, the most diverse. It's about 25% of global GDP.
Mm-hmm.
So it's a quarter of the world's economic activity happens in that
Environment.
piece
Yep.
of land that only comprises of 5% of the global population.
Yep.
So it is a very unique situation, and it's because 72% of the GDP is consumer
Yep.
based. It's amazing to think about. Like, they have everything. They have cars, they have house, they have technology, they have all the gadgets, everything like
Commodities,
that,
everything.
and they just keep consuming, and that drives demand across the world. When you operate under the fiat monetary system, where the dollar is the measuring stick for everything,
Yep.
then other countries do not operate in a vacuum. They operate in this larger context. So, to give you an idea, if the central bank of the United States raises interest rates and you suddenly can get a 3% yield on a 10-year bond,
Mm-hmm.
and in Australia you can't get anywhere close to that, then your central bank has to do something to mitigate the arbitrage, or else your bonds will get sold and people will go and governments, etc., will buy American bonds because they pay way more. So the interest rates usually around the globe, they don't deviate much from each other if we're talking about developed economies, because the risk level is about the same,
Yep.
and there shouldn't be an arbitrage of hundreds of percent between them. So that's one thing to keep in mind. Secondly, 61% of the global currency in circulation are dollars. So when
Mm-hmm.
they raise interest rates and they basically contract the amount of credit in the economy, less dollars everywhere,
Yep.
that means that economic activity in other countries is also going to get crunched. So it's part of this global economy that we operate under. Um, Mortgage rates and just housing demand in general is a function of interest rates, savings,
Mm-hmm.
availability of housing, and good jobs. So when we look at those four, it, pertaining that Australia has good construction companies, and construction is supply and demand in construction is pretty efficient.
Mm-hmm.
Then when you look at jobs depend on the United States as well. The Australian economy is not a self-sufficient economy.
Mm.
It exports and whatnot. So
Yep.
that's one thing. Secondly, like I said, credit. Credit is something that if the U.S. raises interest rates, that makes credit more expensive
Elsewhere.
elsewhere as well. So I think that that's something to think about. And savings, obviously, with the stock market going down, and this being the worst year since 1932 for the stock market for the first half of the year, then the wealth effect and savings of people diminish, and then they have trouble with housing, and
Yep.
that elevates risks. The banks want to take less risk, so the way they do that is by raising interest rates and making sure the people on the fringes are not their customers, because they don't want them
They
at
don't
this
want them
particular
there.
part of the cycle. Yep.
There seems to be like this almost on that larger economic context that you just referred to, the cause and effect. It seems to me, please correct me if I'm wrong, that the war in Europe has also a ripple effect in terms of supply chain. All of a sudden we see that there's this special military operation, and all of a sudden everything goes up in price locally. Fuel, everything that was coming out of Ukraine is no longer coming out of Ukraine in terms of commodities. Um, is that the same sort of context that we're talking about? They have an impact on the economy as well?
Absolutely. Central banks can raise interest rates, and they can sell assets. That's what they do in order to neutralize an overheated economy.
Mm-hmm.
When you raise interest rates, what you're trying to do is impact the behavior of the consumers and the businesses, um, to act differently and demand less, grow less,
Yep.
without causing a recession. You're trying to slow demand, but not hold demand. So if you are thinking about getting a mortgage and now mortgage payments, monthly mortgage payments are up 40 or 50%, you're going to say, well,
Do I want
I'll
to?
delay this.
Yeah.
Yeah, and the wealth effect in the stock market is obviously understood. If somebody had $1 million at the beginning of the year, he now has somewhere in the neighborhood of 800,000 to 750. So he's lost a lot of
A
money
lot of money.
in real terms, especially if he's close to retirement. Those things impact behavior. When they sell assets, they basically create more supply in the open market of bonds, and if you have more supply, then the price falls. So that's price falls, meaning yields go up. So that's two things they do, but they cannot impact OPEC, which is the largest oil shale. They
Mm-hmm.
cannot impact Russia's oil supply. So that's one thing they cannot impact.
Yep.
uh, uh, Governments can impact that with innovative taxation, ease of regulations, negotiations, and whatnot. This is something the governments should do. They do not do it.
Mm.
For the first 6 months of the year, we have not seen any good progress with food prices or energy prices. So, and with congestion in ports, we haven't seen any revolutionary regulation or structures and policies in place, and that's a shame, because if you, I'm sure that they're getting a lot of ideas from think tanks on how to solve these, but I don't know why they don't operate faster.
Sitting on their hands.
So yeah, the demand side is insane. So if you just think about the United States, which is an efficient country with their seaports, they have 2,000 seaports,
Mm.
but two of them, Long Beach and Los Angeles, handle 40% of the imports from the outside. That's
Wow.
why that's why you have tankers sitting there for 9 days. And think about it. In those two ports, there's a shortage of forklift workers and of truckers. But in the United States in general, if this was done more efficiently, there would not be such a shortage and a problem with trucking and logistics. So I think that this is something that's interesting, that's happening, and is just not efficiently solved. So
At the
the
moment.
supply
Yep.
side, the supply side is what's hurting the U.S. economy more than the demand side. The demand, I think, when you kill demand, it's not ideal. You need to just help with the supply side, because it's going to get you more workers, more economic activity, growth.
Yep.
What you're basically doing is telling all the people that want to live, hey, could you, not consume so much?
No, it's good.
So that, yeah, don't consume so much, so these people, so
Balance
this
it out.
side, yeah. So it's almost like Winston Churchill said. He said, with communism, you're making everyone happy by equalizing the poverty, like
Yes.
lowering everybody's
The standards drop
cost.
for everyone.
Yeah. So you may be happy that you're like the next guy, but you're all poor.
You're all poor collectively.
Yes, correct. So I think that the war in Russia started 30 years ago. When the Soviet Union collapsed and into 15 nation states, the Caspian Sea, all of a sudden, with all of its riches, was given to Turkmenistan, Azerbaijan, Uzbekistan, and Kazakhstan. Small countries with limited populations, but they're sitting on this Caspian Sea and all of its riches.
Yep.
And Mother Russia is looking at this and say, hey, this is not a fair division of the wealth of this country. We have put a lot of work to get these resources out on the ground. Now they're not ours.
Yep.
And now 30 years later, they're acting on this. But
it's coming to pass, isn't it?
It's all about oil and natural gas. Russia, in order for its economy to keep being relevant on the global stage, it needs a lot of oil and natural gas. They're a country with very poor infrastructure of seaports, so everything is pipelines, and those pipelines run into other countries that used to be USSR but are not anymore. So that's a very complicated situation. And then Western countries and Western corporations came in, made deals with the Caspian Sea countries.
Yep.
And so that oil is not there anymore for the Russians. And so when the Ukraine made huge discoveries in 2011,
yep,
Putin tried to put in his own president in 2014, and it backfired on him with the revolution. So he invaded for the first time, and now he's invaded for the second time.
Yes.
It's all about resources. So it's not that because he's evil or smart or devious or genius or a terrorist. It's because that's the way he chooses to run his country. And because for the Russians, this is acceptable to do this. So what they're trying to do is just landlock the Ukraine. They're not trying to occupy the Ukraine. They're trying to create a new country, and
annex
with all of the with all the borders being Russian, so they can get access to the Black Sea. The Black Sea leads to the Bosphorus Straits and then to Turkey and Europe.
Yep.
And now you have your way of shipping natural gas, coal, and oil. So
there seems to be a larger strategic plan in place, doesn't there? Obviously.
Yeah, correct. So I don't think that's going away before the mission is completed. So yeah, we should expect that. And then on a bigger scale, what you're seeing with Americans and American companies is that they don't want to start new big expensive projects because they don't like that an SUV rolls around their project one day and the guy says, "I'm from the administration. Why is this, and this not the way we like it?" That's a $40 million fine for environmental and whatnot, and sustainability, blah, blah, blah.
Hypocritical.
It's very hard to operate a business like that. And you saw with uranium and then other alternatives that they call this bluff of governments that are saying, look, we're going to ban all fossil fuels in 5 years, where real life statistics tell you that urbanization and middle class expansion in many countries around the world mean that we're going to consume way more oil and natural gas in the next 50 years than we've ever done. And you cannot have it without that. So if you're looking for that plan, it's all good and well to say tomorrow I'm going to be like Usain Bolt, but it's not going to happen. So the markets have called that bluff.
It's amazing. It's never simple, is it? You need to understand the layers of complexity, and there'd be a lot of people out there, as in mum and dad investors, and not really knowing whether or not there is a safe haven for them at the moment. Do you think there's an upside to all of this? And are gold and silver still a place to go? And what are the speculative markets doing at the moment?
Yeah, in terms of the stock market itself, I think that there are amazing opportunities with world-class quality companies that you can hold for 20, 30 years going forward, because the markets have discounted for recession, for inflation, for war, for many things. And some companies are very attractive. So I think that's one place to start with. You're getting very good deals with some of the markets, with some companies. I would be way more interested in investing in single stocks than in indices right now. Because of these discounts in companies that normally are not that don't trade for a discount for many, many years, because they're such great businesses. Okay, so that's one thing. When we look at gold and silver, people are like, if there's so much inflation, why is gold not at an all-time high? But on the flip side, think about it this way. Gold is performed very well in 2022. It's up 2%.
Yep.
And if you look at the Nasdaq, it's down 33%. The Russell 2000 down 35%. The S&P 500 down 23%. PayPal down 70%.
Wow.
Netflix down, they have 75%.
Yeah.
Shopify, like a global leader in e-commerce, down like 80%
Crazy.
in 1 year, or in 6 months, basically.
Free
So,
fall.
yes. So you're seeing a situation where if you did hold gold, if gold was 5 to 10% of your portfolio, it did exactly what it needs to do. It preserved capital in times when anything that has to do with growth did not.
Did not.
Or did not do it very well. So I think that it is doing exactly what it needs to do. Once the Fed raises by another 75 basis points at the end of July, I think that they will also slow down the pace. I think that they will also start acknowledging that what they're doing, they just cannot continue to do it because they're literally just crashing the stock market, and that's not their objective, right? It's just that the markets are so forward-looking that they're pricing in everything in advance, and I think they'll do what's called a dovish pivot, when they'll become less hawkish, and I think that's when gold and silver will start moving a lot higher. So yeah, I am very bullish on gold. I think silver needs for people to get over the recession fears, because I think we're already in the recession.
Oh.
I think we're going to exit the recession in 2023. This is already a recession. It's just a weird recession.
A weird one.
Because it's people have a lot of savings, and people are still consuming, but we've consumed so much when everyone was cooked up in their homes. We've bought so much goods that we're moving into services, back to services, and the goods companies which comprise most of the S&P 500. You're seeing empty malls. You're seeing less demand for goods and whatnot.
Absolutely.
And that's creating like this recession, basically.
See, that's got nothing to do with investor sentiment, really, has it either? It's just a matter of fact because of all of these different events that have, almost dovetailed. There's never a great time. What have we had? We had the pandemic back, and on the back of that, we've had the special military operation in the Ukraine. It's almost like a master plan the way it's all happened.
Yeah, when you say it's never a good time, I'm assuming you're trying to say that it will never be perfect to get into equities.
That's correct. Yes.
Okay, so the famous Napoleon quote that basically, his soldiers asked him, like, when is the best time to attack? And he said, it's never the best time. We need to attack and
burn the boats.
Yes. So it's always complex, but then when you look at what creates wealth, it is the ability of management teams to overcome complexity and build wealth. If anyone listening to this has never read Triumph of the Optimists, Warren Buffett considered it one of his top 3 books ever, and it just goes and shows you all of the issues we faced in the 20th century and how much wealth has been created throughout. It's almost like complexity leads to more wealth. So people that are newer or less experienced, they want to hold on to their cash because they see the news.
Yep.
But the better idea is to realize that there are people out there so talented that they can overwhelm inflation, overwhelm all these complexities, and build amazing businesses over time. Subscribers to our free newsletter, they know my top, like I have a handful of these companies that I consider to be better than anything you can throw at them. And those are my prime 15 companies for my portfolio. And so we always discuss them on the newsletter. And, if you stick with that kind of a portfolio over time, it's beaten the indices handily. It's beaten
Time
most
again.
hedge fund managers. Yes, if you accumulate shares in the best businesses in the world and become less aggressive when they're priced fairly and become more aggressive when they're priced down, um, I mean,
The
this
world's
is
your
the
oyster
formula.
almost.
This is the formula. You need to own businesses. You need to own assets, despite everything. Um, and yeah, once in 10 years, you're gonna get caught in this in a repricing. But just think about it, Rick. What's happening right now
Mm.
is okay. Let's say I bought something for $100,000.
Yep.
And every day somebody knocks on my door and offers me $70,000 for it, and then 65, and then 60, and 55. As long as I don't do anything with this guy, just shut the door every day. What do I care how much he's quoting my item?
Yep.
That's what's happening right now. If somebody is saying, "Hey, I'll buy your shares of XYZ for this much," and you're like, "Okay, no, thank you, I'm good," then what do you care? What the only reason you should care about the quote, the daily quote of a business that's growing and it's a good position, is if you're in the position that you want to sell it. So unless you're a net seller or you need to sell today, the fact that some of these businesses are down so much, and the business is still intact, its competitive advantage, its growth prospect for the next 20 years, then it means nothing.
Yeah.
It means nothing.
Yep.
When you buy stocks, you should always consider a 50 to 60% downside potential. But the businesses you buy, you need to buy them when they have thousands of percent upside potential. So the risk reward is always going to be in your favor when you buy the right companies.
Yeah, this is amazing. I mean, these are the reasons why I love having conversations with you, Lior, because, you're not part of the Wealth Research Group for no reason at all. I mean, the research and the depth of knowledge and the understanding, you really can't buy that almost. You have to know what you're doing. You have to do the research. And the thing about the Wealth Research Group is that you fast track through your reports, which I am subscribed to coincidentally, and you're getting the inside rail. Now, if you don't mind, I'm wondering if again you can go through as almost like the portfolio of things that you commonly talk about through your newsletters. What have we got? We've got commodities, gold, silver. What else is there?
Okay. I think for the individual,
Yep.
the majority of his investment portfolio should be in American businesses and stocks. I don't see any proven or better way for a person that is a part-time investor, in other words, that is not his main career at all,
Yep.
or his passion for that matter. He just wants to make money.
Yep.
To have exposure to many other things. American businesses give you the best diversification exposure to anything.
Yep.
And with the sectors that they're in. I think that a second layer should be more of the leverage and income that real estate offers. Personally, I don't own real estate anymore under my own personal name. I don't go out there and try to shop for real estate.
Yep.
I do it either through funds or REITs.
Yep.
And so because it's much easier and simpler to do, and you get access to better deals. An individual, I can buy a single family or like a triplex or duplex or whatnot, but through the funds, I'll give you an example. One fund that I'm invested in, the fund just purchased the CBS building in Manhattan. So, on my own, I would never be able to
Have to do
buy.
that. Yeah.
Retirement homes, hospitals, post offices, warehousing, logistics, all these.
The whole array.
Yes, all these portfolios you can never get on your own. Multi-complexes with 300, 400, 500 doors, etc. So With real estate, I like that angle. With stocks, I like to do it on my own. Real estate, this is the better way, in my opinion. Commodities and commodity-related opportunities, those are very cyclical. I would not put more than 15% of my portfolio in them, and I would probably spread them out between 10 and 15 companies. All of them comprising like 1 to 1.5%. I would choose to do a scenario where even the 1% that I'm accumulating, it will be in 2 or 3 trenches. And I would always have an idea in mind of how much I'm willing to risk and make sure that I understand that the potential is very high. Then you have VC, so private businesses, and if you can get into those offer incredible potential. And then cash and just physical precious metals. I like that as having no market risk. In other words, when you have cash, sure, there's inflation out there, but if you held cash, a lot of cash this year, you're a happy camper, even with inflation. So don't discount the importance of cash.
See, I just the diversification and just talking with you, I've learned so much for myself, and I know that there'll be a lot of people on this call very excited to have finally met you, Lior. Thank you very much. Now, again, if you don't mind, in closing up the call today, if you could just share again where they're going to go to get these reports, these newsletters.
Wealthresearchgroup.com is the website. On the top tab, you can actually click on special reports. That's going to have all of the reports that we've ever published. Right next to it, there's a tab called Watch Lists. I think you'll like that. Those are companies that I've researched and I put on my watch list, including these 15 world-class companies. The newsletter, you can sign up for free, and that's like the best way to follow exactly what I'm researching and doing 3 times a week, including specific opportunities that I'm excited about. And the 3 reports I shared on the show, I think they're wealthresearchgroup.com/pain, rug, and bear.
Well, there you go, everybody. If you're on this call and you're looking for that information, no matter where you see this call, you'll most certainly see the links back to Lior and all of these wonderful reports. And as is always the case, Lior, it's just been such a wonderful opportunity for us to spend some time together. Thank you so very much for joining me on the show today.
Thank you, sir.
Thanks for joining us today. If you enjoyed the call, then make sure to subscribe, leave a comment, share us with your friends, and book your spot on the show at myfuturebusiness.com/interviews. And if you're looking for solutions that will help grow your business, then visit myfuturebusiness.com/shop.